Between 2008 and 2020, the Federal Reserve created $9 trillion from nothing, not collected in taxes, not borrowed from other countries, created with computer keystrokes, and gave that money to Wall Street banks who used it to buy stocks and real estate and drive asset prices so high that you can no longer afford a home or retire comfortably, while during the same 12-year period you received $3,200 total in stimulus checks. Not $9 billion, not $900 million, $9 trillion, which is more than the entire US economy produces in 6 months, more than we spent on Social Security, Medicare, and defense combined during those 12 years. And this wasn't a secret conspiracy. This was called quantitative easing and was openly announced by the Federal Reserve. But what they didn't tell you was that every dollar they created made you poorer by destroying the purchasing power of your savings and wages, while making billionaires 300% richer. And by the end of this video, you'll understand exactly what quantitative easing is, how the Fed creates money from nothing, who received the $9 trillion, why it caused the inflation you're experiencing right now, and why this wealth transfer will never stop, because the system is designed to benefit Wall Street at your expense, no matter which party controls government. Before we explain quantitative easing, we need to understand how money creation worked traditionally, and why the Federal Reserve invented this new method in 2008. Normally, when the government needs money, Congress authorizes Treasury to issue bonds. Investors buy those bonds with real money they already have, and the government spends that money on programs. This is deficit spending, and it increases the national debt. But the important point is that no new money was created. Money just moved from investors to government. The Federal Reserve traditionally managed the money supply through interest rates and reserve requirements. If they wanted more money in the economy, they'd lower interest rates, which encouraged borrowing. If they wanted less money, they'd raise rates, which discouraged borrowing. But this method had limits. Interest rates can't go below zero, and in 2008, rates were already near zero, so the Fed couldn't lower them further, and the economy was still collapsing. So the Fed invented a new tool called quantitative easing, and here's exactly how it works and why it's different from anything that came before. Quantitative easing is when the Federal Reserve creates new money electronically and uses that money to buy assets, primarily US Treasury bonds and mortgage-backed securities, from banks and financial institutions. And the key point is that the Fed creates this money from nothing. They don't have $9 trillion sitting in a vault. They literally add zeros to a computer account. And this isn't a conspiracy theory, this is openly acknowledged. Former Fed Chairman Ben Bernanke admitted in an interview that the Fed creates money electronically with keystrokes. And here's the step-by-step process. First, the Fed announces a quantitative easing program and says we're going to buy $1 trillion of Treasury bonds over the next year. Second, the Fed creates $1 trillion by adding numbers to bank reserve accounts. This money didn't exist before. It's created in the moment. Third, the Fed uses this newly created money to buy Treasury bonds and mortgage-backed securities from the 24 primary dealer banks, which include Goldman Sachs, JP Morgan, Citigroup, Bank of America, Morgan Stanley, and other major Wall Street firms. Fourth, these banks now have $1 trillion in cash that they didn't have before, cash that was literally created seconds ago. Fifth, the banks use this cash to buy other assets, primarily stocks, corporate bonds, and real estate. Sixth, asset prices rise because there's more money chasing the same number of assets. Seventh, people who own assets, which are primarily wealthy people and billionaires, become richer on paper because their stocks and real estate are worth more. Eighth, people who don't own assets, which is most working Americans, become poorer because the dollars they earn through wages can now buy less than before. Here are the exact numbers of how much money the Federal Reserve created through quantitative easing and when each program occurred, and these numbers are from the Federal Reserve's own records, so they're not disputed. QE1 ran from November 2008 to March 2010. The Fed purchased $1.7 trillion of assets, primarily mortgage-backed securities and Treasury bonds. The stated goal was to stabilize financial markets after the 2008 crisis. QE2 ran from November 2010 to June 2011. The Fed purchased $600 billion of Treasury securities. The stated goal was to support economic recovery. QE3 began in September 2012 and continued until October 2014. The Fed purchased $1.6 trillion of mortgage-backed securities and Treasury bonds. This was called open-ended QE because the Fed didn't announce an end date initially. They just kept buying $45 billion per month in Treasuries and $40 billion per month in MBS until they decided to stop. QE4, though the Fed didn't officially call it QE4, began in March 2020 in response to COVID and continued through March 2022. The Fed purchased $4.8 trillion of assets, the largest QE program ever. This brought the Fed's balance sheet from $4 trillion to $9 trillion in just 2 years. The total across all 4 programs is $9 trillion, and if you add the additional purchases the Fed has made since then, including the stealth QE that restarted in late 2023, the number is over $10 trillion, but we'll use $9 trillion for this video, because that covers the main QE programs from 2008 to 2020. Now let me show you exactly who received this $9 trillion and why it went to Wall Street, not to you, because this is where the wealth transfer becomes obvious. The Federal Reserve can only buy assets from what are called primary dealers, which are 24 banks and financial institutions that are authorized to trade directly with the Fed. These include Goldman Sachs, J.P. Chase, Citigroup, Bank of America, Morgan Stanley, Deutsche Bank, Barclays, Credit Suisse, UBS, and about 15 others, mostly large Wall Street banks and foreign banks with U.S. operations. When the Fed does QE, they announce they're buying $100 billion of Treasury bonds this month. The primary dealers sell those bonds to the Fed, and the Fed pays them with newly created money. So Goldman Sachs might sell $10 billion in bonds to the Fed. The Fed credits Goldman's reserve account with $10 billion that didn't exist before. And Goldman now has $10 billion in cash to deploy. And what does Goldman do with that cash? They don't lend it to small businesses or homeowners. They buy stocks, corporate bonds, real estate, commodities, and other assets that generate returns. And because all 24 primary dealers are doing the same thing, there's massive new demand for assets, which drives prices up, which makes people who already own assets richer. Here's the proof that this is what happened. Between March 2009, when the stock market bottomed after the 2008 crisis, and January 2020, right before COVID, the S&P 500 rose from 666 to 3,386. That's a 408% increase. And this happened during a period when real GDP growth averaged only 2% per year. So the economy grew slowly, but stocks went up 5 times. Why? Because the Fed was pumping trillions into the system through QE, and that money was flowing into stocks. Compare what Wall Street received versus what you received during the same period, and you'll see the complete inequality of the wealth transfer. Wall Street banks received $9 trillion in newly created money from the Fed through QE, asset purchases. This money went directly into their accounts, and they used it to buy assets that made them and their wealthy clients richer. You received $3,200 in stimulus checks. In April 2020, you got $1,200 from the CARES Act. In December 2020, you got $600 from the Consolidated Appropriations Act. In March 2021, you got $1,400 from the American Rescue Plan. Total $3,200 over 12 months, and that's only if you qualified based on income. Many people got less or nothing, and this was during COVID. During the previous 12 years, from 2008 to 2020, you got 0 direct payments from the government. Now let's do the math on the wealth transfer. $9 trillion to Wall Street versus $3,200 to you. That's a ratio of 2,812,500,000 to 1, meaning for every dollar you received, Wall Street received $2.8 billion, and you're supposed to believe this system is fair. And here's the proof of how this wealth transfer affected actual wealth distribution. In 2008, before QE started, total billionaire wealth in the United States was $1.4 trillion. By 2021, total billionaire wealth was $5.1 trillion. That's a 264% increase. Billionaires didn't work 3 times harder or become 3 times smarter. They just owned assets that the Fed's money printing inflated. Meanwhile, median household income adjusted for inflation was $54,000 in 2008 and $57,000 in 2020. That's a 5% increase in 12 years. barely above inflation, so while billionaires got 264% richer, you got 5% richer, and actually, you got poorer because, as we'll explain next, the real inflation caused by QE was much higher than official numbers, so your 5% wage increase didn't keep up with the real cost of living increase. What would you do if you discovered that the reason you can't afford a house anymore is because the Federal Reserve created $9 trillion and gave it to Wall Street banks who used it to drive up real estate prices, and the reason your savings earn zero interest while inflation destroys your purchasing power is because the Fed keeps interest rates artificially low to make QE work, and the reason your wages haven't kept up with the cost of living is because QE creates asset inflation first, which benefits owners, while wage inflation lags behind. This is exactly what happened, and most people don't understand the connection between QE and their declining standard of living, because the media and politicians never explain it clearly. If you're starting to understand that quantitative easing is the largest wealth transfer from working people to Wall Street in human history, that $9 trillion created from nothing and given to banks is why you can't afford a home or retire, that the inflation you're experiencing right now is the direct result of the Fed's money printing. Stay with me, because what comes next will show you the exact mechanism of how QE causes inflation, why the Fed can never stop doing QE without crashing the economy, and how this system is designed to permanently transfer wealth from workers to asset owners. Subscribe now because very few channels will explain the direct connection between Federal Reserve policy and your declining living standards, and understanding this connection is the only way to protect yourself from the next round of money printing. Here's exactly how quantitative easing causes inflation and why it affects different parts of the economy differently, because understanding this explains why housing and stocks became expensive while the Fed claimed inflation was only 2%. When the Fed creates $9 trillion through QE, that money enters the financial system first through the primary dealer banks, and these banks immediately use that money to buy financial assets like stocks, bonds, and real estate investment vehicles. So the first effect of QE is asset price inflation. Stocks go up, bonds go up, real estate goes up, but consumer goods like food and clothing don't go up immediately, because the newly created money is in the financial system, not in your pocket. This is why from 2008 to 2020, the Fed could claim inflation was under control at around 2% based on the Consumer Price Index. While at the same time stock prices quintupled and housing prices doubled, they were measuring the wrong kind of inflation. Asset inflation was running at 15 to 20% per year, while consumer inflation was 2%. But asset inflation is what matters to you because assets are what you need to buy to build wealth. You need to buy a house, you need to buy stocks for retirement, and QE made those assets unaffordable. Eventually, however, asset inflation leaks into consumer inflation through several mechanisms. First, housing price increases lead to higher rents because landlords pass through their higher costs. Second, wealthy people who made money on stocks spend more on luxury goods and services, driving up prices in those sectors. Third, companies that benefited from cheap Fed money and stock buybacks raise prices because they can. And fourth, the massive increase in money supply eventually causes general inflation when there's more money chasing the same amount of goods. This is why from 2021 to 2023, you experienced the highest inflation in 40 years. It wasn't Putin's fault or supply chain issues or corporate greed. Those factors existed, but the underlying cause was the $4.8 trillion the Fed created during COVID QE4. That money sat in the system for a year or two, causing asset inflation. Then it leaked into consumer inflation, and suddenly your groceries cost twice as much, and you can't figure out why, because nobody explained that the Fed's money printing from 2 years ago is hitting your wallet now. Here are the specific numbers showing how QE destroyed your purchasing power and made assets unaffordable, and these numbers are documented fact, not opinion. Housing prices, the median U.S. home price in 2008 was $203,000. By 2020, it was $347,000. That's a 71% increase. But median household income only increased 17% during the same period, so houses became massively more unaffordable relative to income, and this was directly caused by QE. The Fed bought $1 trillion in mortgage-backed securities, which pumped money into the housing market and banks and investment firms used cheap Fed money to buy properties. Stock prices: the S&P 500 was 666 in March 2009. It reached 4,818 in January 2022. That's a 623% increase in 13 years, and this happened while corporate profits grew only about 80%, so stocks became massively overvalued relative to fundamentals, and the cause was QE. Money flowing into equities. Your savings. If you had $100,000 in a savings account in 2008 earning 5% interest, you'd earn $5,000 per year, but the Fed dropped interest rates to near zero to make QE work. So from 2009 to 2021, your savings earned almost nothing, maybe 0.1% or $100 per year. So you lost $60,000 in potential interest income over 12 years. That's money. The Fed stole from savers to give to borrowers and banks. Real wages median household income was $54,300 in 2008. By 2020, it was $67,500. That's a 24% increase. But if you adjust for real inflation, not the manipulated CPI, real wages actually declined. John Williams at Shadow Stats calculates real inflation averaged about 8% per year during this period, which means you needed your income to increase 96% just to stay even, but it only increased 24%, so you're 72% poorer in real terms. Now let me show you why the Federal Reserve can never stop quantitative easing without crashing the entire financial system, and why this means the wealth transfer from you to Wall Street is permanent. The problem is that the $9 trillion the Fed created is now embedded in asset prices. The stock market is valued assuming continued Fed support. Real estate is priced assuming low interest rates and Fed MBS purchases, and the entire financial system is addicted to cheap money. So if the Fed stops QE and tries to shrink its balance sheet, several things happen immediately. First, interest rates rise because the Fed is no longer buying bonds, which means bond prices fall, which means anyone holding bonds loses money, and since banks hold trillions in bonds, rising rates could make banks insolvent, which is exactly what happened in March 2023 when Silicon Valley Bank failed because it held long-term bonds that lost value when rates rose. Second, mortgage rates rise, which means housing becomes even less affordable and housing prices start to fall, which means homeowners lose equity and banks that made mortgages face losses. Third, stock prices fall because higher interest rates make bonds more attractive relative to stocks, and because companies that borrowed cheap money to buy back stock can't do that anymore. Fourth, corporate debt becomes harder to refinance. Companies that borrowed trillions at low rates during QE now face higher rates when their debt matures, which means defaults increase, which means corporate bond prices fall, which means pension funds and insurance companies that hold those bonds lose money. The Fed tried to stop QE and reduce its balance sheet in 2022 and 2023. They called it quantitative tightening. They raised interest rates to 5% and stopped buying assets. And what happened? Silicon Valley Bank collapsed in March 2023. Two other banks failed. The stock market fell 25% in 2022, and the Fed had to restart emergency lending to prevent a full crisis. So by late 2023, the Fed quietly started QE again. They didn't call it QE, they called it the Bank Term Funding Program. But it's the same thing, creating money to buy assets and support banks, so QE never actually stopped. It just got renamed. This proves that the system is trapped. The Fed can't stop QE without crashing everything. But continuing QE means continued inflation and wealth transfer. So they're choosing continued wealth transfer because that protects Wall Street, even if it destroys the middle class. Here's the evidence that Wall Street knew exactly what would happen when the Fed did QE, and they positioned themselves to profit while you paid the cost. In 2008, when the Fed announced QE1, Goldman Sachs issued a research note to clients telling them to buy stocks because Fed money printing would drive prices up regardless of economic fundamentals. This is documented. The note said the Fed's balance sheet expansion will be positive for risk assets, meaning stocks. And Goldman's clients who read that note and bought stocks made fortunes. Meanwhile, you were being told by financial advisors to dollar-cost average into your 401k and hold for the long term, which meant you were buying stocks at the top of the QE inflated bubble. In 2020, when COVID hit and the Fed announced QE4, hedge funds and billionaires bought stocks within days. Jeff Bezos, Elon Musk, Mark Zuckerberg and others bought billions in their own company's stock in March and April 2020, right after the Fed announced unlimited QE. They knew the stock prices would soar because of Fed money printing, and they were right. The S&P went from 2,300 to 4,800 in 2 years. Meanwhile, you got a $1,200 stimulus check and were told to stay home, and by the time you realized stocks were going up, they'd already doubled, and you missed the run. The insiders always profit from Fed policy because they understand the system and have advance notice through their connections to the Fed. And you always lose because you find out last and the media doesn't explain what's really happening. The defenders of quantitative easing make several arguments about why it was necessary and beneficial, and all of these arguments are either misleading or outright false. They claim QE saved the economy from collapse in 2008, but this is unprovable because we can't run the counterfactual. Maybe letting bad banks fail and prosecuting fraud would have been painful short-term, but would have created a healthier economy long-term. Instead, we bailed out the banks that caused the crisis and made them bigger and more powerful than before. And we created moral hazard, where banks know they'll always be bailed out, so they take excessive risks. They claim QE lowered unemployment, but unemployment fell primarily because the labor force participation rate dropped. Millions of people stopped looking for work and weren't counted as unemployed. And the jobs that were created were often part-time or gig economy jobs without benefits, so the quality of employment declined while the headline unemployment number looked good. They claim QE didn't cause inflation because CPI stayed around 2%, but this ignores asset inflation, which is the inflation that actually matters to building wealth, and it ignores that CPI is manipulated through hedonic adjustments and substitution effects that understate real inflation. Shadowstats calculates real inflation was 8 to 10% per year during the QE period, while the official CPI said 2%. They claim everyone benefited from QE because stock gains flowed into pension funds and 401ks. But this is false. The top 10% of Americans own 89% of all stocks. So when stocks go up, 89% of the benefit goes to the wealthy, and even people with 401ks lost because the wealth transfer from QE made housing and college and healthcare unaffordable, which costs more than their 401k gains. The practical long-term consequences of quantitative easing extend far beyond just making asset prices higher. It fundamentally changed the structure of the economy and American society in ways that benefit Wall Street and harm everyone else. First, QE made wealth inequality permanent and accelerating. Before QE, wealth inequality was high, but at least working people could save money in a bank account, earning interest, and build wealth slowly. QE eliminated interest income for savers while inflating asset prices. So now the only way to build wealth is to already have wealth invested in assets. If you're starting with nothing, you can't catch up because assets are too expensive and your wages don't keep up. So wealth inequality will continue widening forever under this system. Second, QE destroyed the housing market for young people. Home ownership rate for Americans under 35 fell from 43% in 2005 to 37% in 2023 because houses that cost $200,000 now cost $400,000, while wages only increased 20%, so entire generation is locked out of home ownership, which was traditionally how middle-class families built wealth. Third, QE created a rentier economy where ownership of assets is more profitable than working. If you inherited a house or bought stocks early, you make money by doing nothing while the Fed inflates prices. But if you work for wages, you fall further behind every year. This creates a two-tier society of asset owners and workers, where asset owners live off the workers' labor. Fourth, QE made corporate debt unsustainable. Corporations borrowed trillions at artificially low rates enabled by QE. But when rates eventually rise, either those companies default or the Fed has to keep rates low forever, which means more QE and more inflation. So the economy is trapped in a cycle of ever-increasing debt that can never be paid back. Here's what's happening right now in 2024 and 2025, and why you're about to see another massive round of QE that will make you even poorer. Commercial real estate is collapsing. Office buildings are 40 to 60% empty because of remote work, and these buildings are financed with mortgages that are coming due, and the buildings are worth 30 to 50% less than the mortgage values. So regional banks that made these loans are insolvent, but hiding it by pretending the loans are still worth full value, and this is exactly like 2008 with residential real estate, except this time it's commercial, and when the defaults start cascading, the Fed will have to do QE5 to bail out the banks again. The US government deficit is $2 trillion per year and growing, and at some point, foreign investors will stop buying treasury bonds at current rates because they're worried about the dollar losing value, and when that happens, the Fed will have to become the buyer of last resort for treasuries, which means unlimited QE to fund the government, and that will cause massive inflation because it's direct monetization of debt. The national debt is $35 trillion and will be $40 trillion by 2030, and the interest on that debt is already $1 trillion per year and rising, and eventually the only way to pay the interest will be to print money, which is QE. So we're locked into a cycle where the Fed must keep printing forever or the government defaults, and every time the Fed does more QE, your savings lose value, asset prices go higher relative to your wages, and wealth transfers from workers to asset owners, and this will continue until either the dollar collapses or the people wake up and demand change. But change won't come from voting because both parties are funded by Wall Street and both parties support the Fed's policies. Now you understand exactly what quantitative easing is, the Federal Reserve creating money from nothing with computer keystrokes. You understand that $9 trillion was created between 2008 and 2020 and given to Wall Street banks who used it to inflate stock and real estate prices. You understand that you received $3,200, while billionaires became 300% richer. You understand that QE caused the inflation destroying your purchasing power right now. You understand that the Fed tried to stop QE in 2022 and banks started failing, so they had to restart it. You understand that QE can never stop without crashing the financial system because asset prices are now dependent on continued Fed money printing. And you understand that this means permanent wealth transfer from workers to asset owners, and the only question is whether you'll accept this system or whether you'll get angry enough to demand change. But demanding change requires understanding that both political parties are captured by Wall Street, that the media won't explain this to you because they're owned by the same billionaires who benefit from QE, that the academic economists who defend QE work for banks and the Fed, and that the system is designed to benefit insiders at your expense. So unless millions of people understand what you now understand, QE will continue, inflation will continue, wealth inequality will continue accelerating, and you'll work harder every year to fall further behind, while Wall Street celebrates record profits from money the Fed printed and gave them. If this explanation of how the Federal Reserve created $9 trillion from nothing and gave it to Wall Street while you got $3,200 and can no longer afford a house has made you understand that your declining standard of living isn't your fault, but is the direct result of deliberate Fed policy designed to benefit asset owners at the expense of workers. If you finally understand why inflation is destroying your purchasing power and why it's not supply chains or Putin but the $4.8 trillion the Fed printed during COVID, if you're realizing that the system is rigged and the only way to survive is to own assets, not earn wages, because the Fed inflates assets and destroys cash, then you need to see what we reveal next, because QE is just one part of a coordinated wealth transfer system. Subscribe now and prepare to discover how the carried interest loophole lets private equity billionaires pay 15% tax on trillions while you pay 37%, how the stepped-up basis lets wealthy families erase capital gains at death and pass billions to heirs tax-free, how Wall Street is using Fed money to buy every single family home in America and turn the country into a renter nation, and how the coming commercial real estate crash will trigger QE5 that makes the previous $9 trillion look small, because once you understand the complete picture of how the Federal Reserve, Congress, and Wall Street work together to transfer wealth from working people to billionaires, you'll understand why no matter how hard you work, you'll never get ahead under this system, why your children will be poorer than you, why the American dream is dead for everyone except those who already own assets, and why this will never change through voting because both parties serve the same Wall Street masters who fund their campaigns and profit from Fed money printing, so the transfer continues. The next QE is already planned, and you'll pay for it with inflation that destroys your savings, while billionaires add another trillion to their wealth.